Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. The last few years have been a fascinating time for the property market. While house prices soared during the pandemic, they're now dropping right around the country. But plenty of investors have found good opportunities in the sector, with industrial and warehouse demand soaring during the e-commerce boom. But what about those other types of property, including office buildings and commercial property? It's a very varied sector and definitely worth a closer look. Remember, this is general information only, and you should seek professional advice before making investment decisions. Trilogy Funds is an Australian fund manager and financier of property-based investments. Philip Ryan is the co-founder and managing director of Trilogy Funds, which is a supporter of this podcast. Philip, welcome to Fear and Greed.
Oh, thank you, Sean. How are you?
I'm well, thank you. Now, look, we haven't spoken for a year or so. Property market really has changed in that time, hasn't it?
That's right, particularly in relation to interest rates. I think last time we spoke, the official cash rate was 0.1%.
Yeah. So in commercial property, what's that done? What's it really mean? So maybe we talk about industrial first because we talk so much about that. But can you take us through retail, office, those sectors?
Yeah, sure. Look, it's interesting when you look at commercial property, particularly in my hometown of Brisbane, has struggled really in relation to the city, inner city areas, and that's because of oversupply. So there's two factors there. One is, of course, people working from home, and the other factor is that there's been too much construction in the area. So as a result, landlords have had to compete with other landlords in order to attract suitable tenants. And as a consequence of that, they've had to provide quite a lot of incentives in order to get those tenants. So the incentives are typically rent-free periods. It might be fit out, etc. And as a result, that impacts in terms of the return which is available for investors in those particular trusts. There's also one other thing which is quite pertinent, and it relates to the difference between commercial and industrial leases, Sean, and that is that when I was a young lawyer, going back about 20 years ago, it was quite typical for leases and commercial property to provide for rent review in terms of increases in both the CPI, in other words, the inflation rate, and also a minimum rate of return, which is usually about 2 or 3%. But over time, because tenants have been able to be more of a stronger force in terms of negotiation than what they would have been, say, 20 or 30 years ago, what you've found is that it's been more likely the case these days that there's a fixed rate of return, there's a fixed rate of increase. So when you look at a commercial property these days, the rate of review for rents is usually in that order of 2 or 3%. Now, of course, You contrast that to industrial, and industrial, I think, is a more vibrant sector. It's performed so much better during the pandemic and doesn't have that oversupply issue typically. And with industrial, you find that the rents are more along those lines of what I described 20 or 30 years ago, which is that it provides for a rate of increase according to the growth in the CPI, or 2 or 3%. Now, as a result, investors in industrial property are more likely to get the benefit of increases in inflation, whereas investors in commercial property are missing out on that at the moment.
Okay, and when you're talking about commercial, you're talking about the office towers, and you're talking about retail, all that as well?
It's commercial but mainly, but it does also concern retail, particularly where there's an oversupply of retail investment.
Okay, so with those office towers, what's the prognosis for that? Because it is difficult to get people to come back into the office, undoubtedly, but I'm sure there'll be very few companies who actually want to go totally work from home. Everyone wants hybrid. How does that play out over the next few years, do you think?
Well, I think it's a case of having demand and supply forces basically become more of an equilibrium. At the moment, it's very much in the tenant's favour. And again, I'm using Brisbane as an example. It's quite common in Brisbane for incentives to be in the order of in the 30s and 40%. So that's a large portion of rent which would normally go to the landlord being actually rebated back to the tenant. Now, where that goes from here is interesting. I've noticed in our own business, the young people in our own business couldn't wait to come back into the office.
Right.
And so we've always had quite a strong belief, particularly by the young people, to come and work back in the city. And as a result, they get get the benefit of culture, they get the benefit of training. For larger organisations, I know if you look at our banks and also larger insurance companies and also government departments, it's been more the case that the difficulty people are finding is, of course, once people work away at home, it's very hard to bring them back because that's become ingrained in terms of their culture, which is going to be difficult going forward. I don't think we should write off the cities just yet. I think the cities will undergo a resurgence because it's all very well working remotely, but when you work remotely, you miss out on human contact, you miss out on coffee shops, you miss out on all the amenity which a larger city provides.
Stay with me, Philip. We'll be back in a minute. I'm speaking to Philip Ryan, co-founder and managing director of Trilogy Funds. Okay, so as an investor then, from an investor point of view, what should I be looking at when I'm thinking about commercial property? If I have a diversified portfolio, I want to make sure I'm in commercial property one way or another. Is it a sort of a market in Australia at the moment where you're kind of very geographic specific? Is it, how should I think about it?
Yeah, it's a good question, Sean. I think with commercial, you've got to take a quite a long-term approach to it. And also you've got to look at it, well, when does it reach its bottom? And I suspect that's probably not too far away because obviously if incentives are very high and there's an oversupply of commercial property, markets tend to move back towards equilibrium. In other words, new projects aren't being built. And I suspect that might be the case in our major cities quite a few years to come. Now, having said that, in Brisbane, I noticed that Dexus are building 2 new towers, which are projected to be completed in about 2026. Now, by that period of time, the market may have moved more towards an equilibrium. In other words, we'd see more people come back into the city, and also we would see that there's not much other stock being created during that period of time. So I suspect that if investors take a long-term approach to it and think that now's is a good, if you like, a contrary or a counter approach to investing in something, it'd be a good investment.
And then in some other asset classes, people talk about the flight to quality in these times. I mean, the currency is the big example. Everyone loves the US dollar at the moment. Is it a bit the same in property where kind of the highest star properties are likely to attract investors more than the lower star properties?
Absolutely. Look, it's really interesting just how much that plays out in commercial property in particular. If you look in each of the major cities in Australia, the properties that have the lowest vacancy are actually the A grade and premium grade buildings. Right. When you go down to the Bs and Cs, they generally have a high degree of vacancy. And that's because they don't offer the same amenities. People do have a flight to quality as a tenant, particularly when you consider that as a tenant, you've actually got the strongest bargaining position. So they gravitate towards the highest quality buildings. Obviously, there's an ESG element there too in terms of what is the most efficient in terms of energy efficiency. So that plays a part as well.
Okay, now Trilogy also provides non-bank lending to the property development and construction sector. What's happening in that space? Because anecdotally, you hear some not so good stories.
Yeah, well, Sean, in terms of property prices, you're quite correct in that residential prices overall have dropped. And of course, you see the CoreLogic statistics come out every month as to how that goes. But of course, nothing moves quite in such a linear fashion. So you'll find some suburbs and some areas, and I know again in Brisbane and also Sydney and Melbourne, some suburbs will have already moved down 10%. Some would have been 15%. On the other hand, other areas are reasonably stable. And in fact, in some cases, they would have increased. Places like Noosa, for example, which seems to run to a different drum than every other part of Australia. So that is the case. What's interesting in our portfolio in the Trilogy Monthly Income Trust is that most of our valuations, when you look at them, are holding up very well. So if they are valued at, say, early part of 2021, what you'll find is that as those projects have come to completion, that while prices have dropped from the peak, but the peak was back in late 21 and early 22, they're actually still above valuation. And when we've done an overall portfolio review, it's been very rare where any prices which have been achieved are actually less than valuation. And if they are, they might be, say, 5%, up to 5%. But it's surprising, on the other hand, how many are actually selling in the current market still above valuation. And I think part of that also goes to the valuers, because the valuers went through COVID in 2020, obviously quite alarmed. You remember the prognosis, and the commentators at that time were saying that, well, property will fall in a heap and prices could go down 20 to 30%. And of course, valuers, being conservative by nature and also concerned about what was happening in the broader economy, were very conservative in terms of their approach to valuation. So we haven't seen the same instances as we saw during the GFC, and that was where there was a build-up of overconfidence and over-optimism, but also in those markets back then, you saw a lot of oversupply, particularly at areas like the Gold Coast and other areas of Sydney in particular as well. We haven't seen that oversupply this time, and I think that provides some robustness in terms of property prices.
Let's hope so. Philip, thank you for talking to Fear and Greed.
Thank you. Thanks, Sean.
That was Philip Ryan, co-founder and managing director of Trilogy Funds, a supporter of this podcast. This is a Fear and Greed daily interview. Remember, you should get professional advice before making any investment decisions. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.